So start with the most basic question. You've experienced a lot of these proxy battles through your career. When do they work and when do they not work? And by work, I guess I mean for the purpose of the company and the shareholders. When do they create value? When do they not?
Well, I think investing in activist campaigns in the U.S. capital markets are critically important as a way for shareholders to enforce good capital allocation management, executive execution, and strategy at companies. Now, most companies, of course, get those things right in the first place and don't need shareholder intervention in order to be on the optimal path to value creation. But of course, there's always the straggler company or two where, for whatever reason, the board's interests may not be aligned, their skill sets may not be, perfect in order to understand the risks and opportunities that the business has. And in those cases, having sort of this safety valve of activist investors who can come along with ideas and try to push a company in a different direction can make a huge difference in the success of that company. And I think it's important for the capital markets because of the safety valve function, the sort of the self-regulatory function that activist investors can serve in the market.
Where are we in this proxy season thus far? I've seen some reports there's been a drop-off in some of the activist campaigns. Is that true? And if so, what do you think accounts for it?
Yeah, I think, part of what we're dealing with is a small numbers problem. There just aren't that many campaigns that actually go to a proxy fight every year. There's sort of 50 or so. So in any given year, it might be higher or lower. But Bloomberg tracks as well demands made by activists, public letters written by activists, and which is a much larger universe of companies. And in that universe, we are seeing a small drop-off relative to 22. 22 was a high water mark, so it was a little pent-up demand probably from the pandemic. But we have seen some drop-off in sort of numbers of campaigns this year.
And what might account for that? I mean, I've heard it attributed to higher interest rates, which makes it more difficult to finance some of the things you might want to do with it. Also, the stock market has done pretty well thus far this year, so maybe people, when a rising tide is lifting all boats, it's harder to get people to jump ship.
Yeah. Interestingly, well, I do think it's those two things. I think it's some other things as well, some of which are related, actually. But we've got a dampened M&A market where activists, very frequently used to have as a campaign theme, look, you'd be better owned by someone else who could extract more value from your assets or brand or market position. That's harder to argue for when M&A activity is down. Multiples were down at the end of last year. Obviously, interest rates higher to finance those takeouts. PE firms being, a little more cautious about acquisitions. So I think there's some dampening of activist claims or demand opportunities because of the M&A market. I think there's a second cause, actually, which is that last year performance among activist investors was down significantly, on average worse than the market. And I think there's a fair amount of sort of licking wounds, trying to fix the companies they're already in rather than launching entirely new campaigns. When the portfolio has already been suffering losses.
Tell us about the advisory business, because at least last year, I think you were at the top of the league tables, as I recall.
Well, we like to think so, yes.
Yeah, exactly. And I'm not sure where you are this year, but how do you compete for that business? I mean, how do companies' boards of directors pick you versus someone else?
Well, only the smart ones do, of course. No, look, there's an entire industry that's cropped up in the last 10 years of people who are assisting companies in these situations. And sometimes I like to say it's anybody who ever stood next to a proxy statement, now claims to be an expert and is helping companies. For the most part, I think companies do a pretty careful job of selecting who they're going to seek advice from. This is often a very sort of harrowing, nerve-wracking situation where you as a director, usually an accomplished professional or former executive, is now being challenged, and your judgment and your reputation, and in some sense, the work you've done is being challenged by an outsider. And so, unsurprisingly, you seek good assistance, and I think people turn to trusted advisors who have experience in this, area to help them understand the minefields and the landscape. One of the things we know is that proxy contests, if you get there, are usually lost by the loser and not won by the winner. And that makes it all the more important that you don't make mistakes along the way and you seek good advice and input.
You raised an interesting question, though. How do you determine who wins and who loses? I mean, we had a big situation with Disney, for example, and that was ultimately settled. I don't think that they replaced any people on the board. And yet some would say that actually Disney, to some extent, has course corrected, maybe coincidentally or maybe in response. How do you know whether you're winning or losing?
Well, I think Disney's a hard situation. I think it was probably a win all around. I mean, everybody gets, everybody gets stars. I think the company's probably in better shape. I think Trian, got the outcome they were looking for. But look, there were other circumstances where there was a clear loser. I mean, Pitney Bowes clearly lost. Massimo clearly lost, right? Salesforce, I would say, clearly, won, or at least they got themselves through the minefield without, having to make dramatic changes to the business model, despite having, multiple activists, chasing them around and making suggestions. So sometimes it's clear, sometimes it's sort of less clear. I think on average, shareholders win by virtue of this activity in the capital markets, which tends to just nudge people back onto the path of optimal, and also gives other directors some nervousness about the decisions they're making, and sort of has a general deterrent effect as they're making decisions about the future direction of companies.
One of the subjects that's gotten a lot of attention in the media is environmental social governance investing. We've seen a lot of shareholder initiatives, a lot of attempts to have proxy fights over that. Is that a large factor in your business?
It isn't really. I mean, I think boards are attentive to these issues for sure, as are management teams, and ever more so because the shareholders who own the companies care and express their concern more and more. But I'll tell you, when we get phone calls from a chairman of a board or a CEO, and they're nervous and worried about the path forward, it's not usually because of a sort of an ESG issue as much as it is what I'd call an economic activist, someone who thinks that the company either ought to be sold or have a different capital structure or a different management team or a wholesale change in the board. Those are the ones that certainly garner the most attention from the board and management team. The ESG issues, I think people care about for sure. They don't tend to breed as much nervousness and as high stakes, of a situation.